I mean, when I got in the business, it was a cottage industry on whether the Fed had cut rates or not, right? I mean, people would go through the balance sheet and figure out it's a completely different.
Didn't you get into the business before the Fed even came into an existence? I mean, you were like reading like JP Morgan's like briefcase size to like figure out whether they were going to like bail out the financial system or not?
It was how fast his carriage was going. It's how fast his carriage was getting downtown.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
All right, welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is Friday, December 12th, 2025. I'm Steve Duttenhofer.
I'm Jeff deGraaf.
I'm Neil Dutta.
And I'm Steve Pavlick.
And that is Nick Timiraos. Nick Timiraos, thanks for joining the pod this morning.
Thanks for having me.
You bet. So, last week on the pod, we said that all eyes were going to be on the Fed this week. And then we're fortunate enough to have Nick Timiraos on the pod this week, who many regard as the Fed whisperer. So it's a real treat to have you on. For those that don't know, Nick is the chief economics correspondent for the Wall Street Journal, covers the Fed and all the major developments in U.S. economic policy. Been there for 19 years. Is that right, Nick?
That's right.
Graduate of Georgetown, a proud Hoya, was the editor of The Hoya. The newspaper, I don't think that should be a shock to anybody, is the author of $1 Trillion Triage, the narrative account of the Fed's response to COVID-19. And as the kids say, he's got a sweet head of lettuce on top of that head of yours. It looks good.
Nice.
A lot of good flow.
Thanks.
Somebody's been looking at the demographics of our podcast, trying to get the younger crowd back in. All right. Well done.
So, Nick, we'll start it off with you. The Fed decision this week, a little bit more mixed than we're used to?
A little bit more mixed, but obviously not a surprise after the October press conference, right? Everybody got so hawked up thinking, this would be another big hawkish press conference. And, it clearly wasn't. Powell seemed to, you talk about flow. He seemed pretty comfortable with where they're at, notwithstanding all of the, swirl of dissents and intermeeting, I don't want to cut agains. So we'll see. I mean, we get the data now, and the data is going to drive this.
And you think it's going to drive us to what? Your best guess for as you look out for 2026?
I'm not a forecaster, so it's a bit of a cop-out. But you tell me where the unemployment rate is in the January 9 release of the December payroll report, and I'll tell you, whether we get the January cut or not. People certainly are keeping their options open. And so it's, I just think the data and the unemployment rate in particular, if you could only look at one thing.
So do you think the meetings are live, Nick? I mean, so in other words, because the market seems to say that that's not the case. So you think that if you do get, let's say, like a dud on the jobs number next week, that it's possible that...
Well, yeah. So Neil, the market right now is just, waiting for the data, right? If you got a dud, especially on the January 9 release, you're not going to be at a 22% chance of a cut anymore, right? So I do think it's live. I think the way that the market will react will tell you that it's live if it is in fact a bad report. We already heard this morning from a 2026 voter, Anna Paulson, and she sounded exactly right in kind of Powell's mode of not going to rule anything out, still worried about the labor market. You're going to hear from all the hawks, including today, but the people who tend to vote more with the chair, they're not ruling anything out at this point.
You might not know it, but RenMac has a free newsletter where we provide many of the charts we're discussing on today's pod. Go to the link in the show notes and subscribe. It's quick, free, and insightful. Now back to the show. Can I ask you a little bit about the Hawks? Because I saw Austin Goolsbee hit the tapes this morning talking about how he still sees a lot of room for rate cuts next year. So why did he dissent? What do you think that's about?
I don't know. You'd have to ask him. I mean, obviously, he had expressed concern with services inflation. If you think things are going to turn up next year, then you're just a little bit more concerned that you're not going to get the downward pressure, right? So I know that's not your view, but I was surprised. I was a little surprised that Goolsbee dissented. I wasn't surprised that there were two hawkish dissents. I think there may have been people who wanted to dissent, who had a vote and decided, okay, more than 3 dissents would not be the right look for the institution here.
Yeah, my money was on the St. Louis Fed president, not Goolsbee, for what it's worth. But I was a little curious about the October meeting. I think you would probably agree that Powell chooses his words carefully, right? So, I mean, do you think? I don't think he meant for that sort of ridiculous shift in pricing that we saw, because at one point I think market implied probabilities for a December cut went down quite significantly before Williams kind of came in and saved it. So do you think that was a communications mishap, or do you think Powell just sort of gave the Hawks license to kind of run with it and see if they could press their case? I mean, it seemed between Williams and the jobs number, right? I think before he spoke, that kind of is what shifted the pricing. I mean, how are you thinking about that?
I didn't get the sense that the October press conference was anything other than what the chair wanted it to be, which was, you're going to hear in a couple of days from people who didn't want to cut at this meeting, who don't want to cut at the next meeting. So I'm just going to tell you now. He kind of scooped all of us and really the hawkish presidents, and just telling everybody, here's where things stand. Rip the Band-Aid off at the press conference. It's going to be a surprise to some people. As to the pricing, I think the surprise right after the October meeting was that the market was still priced 67% chance of a cut, when it probably should have been, closer to 50-50. Then it swung down below. So I think that just shows you it's hard to fine tune where the pricing is going to go for the next meeting. And, obviously once it fell below 50, Williams went out there and communicated having followed Williams for a while, very strong terms. He usually doesn't say hardly anything to try to change pricing. So when he does, it's, except for that one goof in July of 2019, he's doing it intentionally.
Yeah, it got as low as 30%. So that was a pretty big shift, obviously. So helped to obviously spark the rally over the last 3 or 4 weeks. Nick, and you've been covering the Fed a long time. Where would you put the state of the Fed in terms of the institution right now? I mean, is all the noise that's taking place around the institution really outside of the walls, or are they feeling the kind of uncertainty and disarray within the Fed, the institution itself?
Well, so first, the reappointment of the presidents is a sharp object removed from inside the room. So that that's was expected. Bostic retires, but the rest of them get reappointed unanimously. So that's good news for the institution. When they say this has no effect, there's just no way that can be true, right? They can try to tune it out. Of course, you're going to try. You're not going to try to show your independence by doing something other than what you think is the right thing to do. But how can it not be creeping inside the walls at this point? This isn't just, what we saw in the first term, which was the president going on Twitter and kind of calling for lower rates. This has been a much more aggressive, quasi-menacing effort to say we're going to try to get more control here over monetary policy. And so I think it does have at least an effect in how people have to think about what they're doing. I mean, if I come up to you and I hit you, your body's going to react in a certain way, even if you try to stay in the same place, right? So it I'm not saying it has an effect in that it changes how people vote, but there's a lot of political institutional pressure on the place now. And, I think it is helpful for the chair, frankly, to have some of these dissents, because it shows that just replacing the chair does not guarantee that this is going to be an easy path to 2.5% Fed funds next year.
So let's talk about that. I mean, obviously, we're seeing the the Fed chair Apprentice edition play out. I've made my views on it sort of pretty clear. The markets seem to think that the odds-on favorite to succeed Jerome Powell is Kevin Hassett. How do you think about how Kevin Hassett is going to be greeted within the Fed? And do you think that he would have an easier or harder go of it forging consensus amongst the sort of varying views and regional Fed presidents and within the board as well, in terms of trying to, because the president has basically said that, he views it essentially as like a litmus test that the person that he puts up is going to want to push through rate cuts. So how is Hassett going to navigate that, do you think?
And I'm not sure that those comments really help the next chair, right? The more that the next chair is identified as seeking a certain objective independent of the data, the harder it's going to be for the chair to have the credibility to do what Powell did this week, frankly, which was to get, a couple of people who didn't support the decision to vote for it, or who'd made comments. I shouldn't say they didn't support the decision. They'd made comments. Susan Collins had clearly showed reservations about cutting. She voted to support. You mentioned Muslim. So, at the margin, or even more than at the margin, it doesn't exactly help matters. You ask about Hassett. I think the question I hear the most from people around the Fed, former Fed, in the markets is which Kevin Hassett is going to show up at the now the Martin building if he is the next Fed chair. Is it going to be sort of the establishment GOP commentator, economic policy hand who got 81 votes from the Senate for his CEA confirmation in 2017? Or is it going to be the Kevin Hassett that we've heard more from over the last 6 months, who's been a little bit more, taken the Trump adversarial stance towards the Fed? We had Hassett at our CEO Council event here in DC this week, and he was asked about some of this. Are some of the things you're saying, accusing Fed officials of being partisan, of voting to keep interest rates, to not cut interest rates because they're partisan? How is that going to get, people to do what you want? And he kind of downplayed it. He said, I have a great relationship with people at the Fed. He pointed to the vice chair, Phil Jefferson, who he was on the faculty with at Columbia. And he sort of said, look, I'm just pointing out facts. But I think, how he handles himself once he's in the job or in the Senate confirmation is going to be really important to determining how much people are going to go and do what he wants. The arguments are going to have to win out at the end. And I think you can look at, Stephen Myron since September, and I've talked to people, again, around the Fed, questioning these are not the sort of arguments that have really been driving or persuading people to his view. The arguments that Chris Waller has been making since June and July, you now hear those really. On Wednesday from the podium, you hear those views reflected in what the chair is saying. You don't.
Right.
Hear
he even
these
talked
arguments.
about the downward revisions to employment that are likely. So
exactly. So persuasion is really the currency inside the Fed. And if you're going to make arguments that aren't persuasive, the argument about 1990s and Greenspan. Well, Greenspan hiked interest rates, 175 basis points
it's really
in
about
a year,
the labor market.
beginning in June 1999. They ended with a 50 in May of 2000, 6.5% Fed funds rate. Nobody saying, oh, we should, be like Greenspan is talking about that Greenspan.
Right. I think they're talking about a very nuanced, and we wrote about this week for our clients, but I did want to talk a little bit about that. When they say because Hassett's going in there, if he does go in there, with this sort of like golden age supply side productivity boom thesis, which he's arguing that the Fed can accommodate. But I mean, I do think it's kind of worth pointing out that Greenspan didn't really accommodate anything. I mean, if rates weren't, I mean, there was a debate, I think, in the middle of the 90s where he was kind of, Yellen was kind of pushing for, maybe a tighter policy, and Greenspan resisted. I mean, maybe there's some debate about that, but I would just say that if rates weren't really moving in the 90s, it was because the data were telling them not to move rates because inflation was falling alongside the unemployment rate. It was a pretty standard kind of Taylor rule type of evolution, I think, in the funds rate. But you can correct me if I'm wrong about that.
Let's talk a little bit about that, because I think the big distinction between what your forecast is and what you think the Fed's going to do versus what they do is on the health of the economy, obviously, but the employment picture, right? So could you just walk through your thesis as we were traveling around in Canada and Boston this week talking to people? Just walk through your thesis about the outlook for the employment picture.
Well, sure. I mean, I think number one, I mean, we saw in the last week the private sector quits rate decline to fresh lows. So I think that's important because a big sort of view out there is that, immigration is kind of creating all sorts of weird dynamics with the labor market data. But ultimately, if you're booting a lot of people out of the country, shouldn't workers that are still here feel the confidence to go and look for other jobs? The fact that they're not willing to do so suggests that there's more of a demand side component to the weakness in the jobs market than supply. If quits are going down, it means that incomes will probably slow, right? So the balance of power in the jobs market is clearly shifted towards employers. I mean, you have to squint, but it looks like layoffs have been perking up over the last number of months, with all deference to the initial jobless claims data. But if you look at the layoff numbers in the JOLT survey, if you look at WARN notices, it does look like layoffs have been rising. So layoffs are rising and quits are falling. So that tells me that the leverage in the jobs market is shifting to employers, which means that wage pressures are probably going to abate. If wage pressures abate, that really undercuts a core thesis of the bull case, which is stronger consumer spending, right? So if wages are slowing, then real incomes will probably moderate, and that'll take a lot of the momentum or juice out of consumer spending. So that's my view on jobs growth, on the labor markets. I mean, I think, to me, there is a lot of like tempting fate that's going on here, right? I mean, when you say like, let's wait for initial claims to turn up, that's like waiting for credit to give you a big signal. It's episodic. Like by the time it happens, it's over. And I do think, the hawks seem to, I think a lot of people are making this argument, in my view, a mistake, but, unemployment is still relatively low and core inflation is 2.5%. But when you go and kind of look at the bottoms up sort of labor market, it doesn't feel all that great. I mean, we're going into 2026 with home builders sitting on the most unsold inventory since 2011, 2010. I mean, it's not really a good place to be. So tell me why residential construction is going to be adding jobs. You look at things like oil prices, lumber prices. Can a sawmill profitably make lumber with lumber prices as low as they are? I'd argue probably not. Why would an oil rig want to hire a mining worker if oil prices are this low? It's the same reason why they're not investing in new wells. How about even smaller sort of areas within the jobs market, right? I mean, Trump's going to war with the universities. Can you tell me why university and faculty and college higher institution employment is going to be going up? I mean, that's probably going down. And then the last one I would say is state and local governments. State and local governments, there's the news media is littered with stories about budget cuts and layoffs, furloughs, but that's been an area that's been adding a substantial amount to employment growth, about 20,000 ex-education in state and locals over the last year. So we're talking about scope for employment growth to slow, and it already has slowed. So we're running below break even as it is, and I think there's reason to think that that we continue to do that. And I guess my issue is, the Fed, if you look at the Fed's SEP, Steve, I think they have a forecast for 2.3% real GDP growth next year, with the unemployment rate flat at 4.4%. That's the SEP median estimate. I think what's interesting is if you look at growth over the last 2.5 years, we've been doing about that, maybe a little better, like around 2.5% real GDP growth. And what's happened over that 2.5-year period? The unemployment rate's gone up about a percentage point. So why would that change now? So why would anyone think that the unemployment rate wouldn't go up again? So in a weird way, I feel like, maybe to a point that Nick was making earlier, if I'm right about the outlook, it would mean, and it's, if we're right about the unemployment rate outlook, then it's likely the market and the Fed are underestimating the amount of cuts that'll get priced in for, between now and the end of next year.
One thing I want to touch on that, because you mentioned housing, home builders, but housing in particular. What do you think? Because obviously Nick has a unique lens for this because he was down in DC, watching the housing crisis and Fannie and Freddie. But where do you think rates have to go to unleash or unlock the mortgage market or the housing market? And is there anything that the Fed can do that's sort of different that can get things stimulated in that area?
Yeah, so I think like high 4s, low 5s is kind of where rates need to be in order to kind of get the housing market going. Other than that, you're probably going to see pretty significant home price declines across the country, over the next year if that doesn't happen. So that's sort of where I'm at. It is interesting. I'm curious to hear Nick's thoughts about this. Do you feel like the Fed doesn't really focus on housing? It's sort of, I don't know. We did have a big housing problem, in the last big shock outside of COVID, obviously. And it just feels like that's an area where it sort of, I remember back when I was like a young analyst, like Ed Leamer talking about how housing is the business cycle. Do these arguments have salience within the Fed? Do they care a lot about housing, or do they just sort of treat it as kind of like an exogenous thing that it's just it'll do its own thing? Because Powell's going around saying that we have a supply shortage, but personally, I don't believe that. Go to Florida or Texas and tell me there's a supply shortage. There's a glut of homes. That's why prices are collapsing.
Well, I think the issue is that you have an affordability problem, and the concern would be that if rates come down a lot and you stimulate more demand, you're not, then you're just going to see prices go back up. So they're kind of stuck here. Some people I talk to think the best thing would be for just prices to be flat, maybe, declining in real terms, but not nominally. And over time, as rates can come down a little bit, you kind of grind through the affordability challenge in the same way we did in 10, 11, 12, 13, when the problem was oversupply, and you just had to work that off over time. And you want, nominal income growth to be strong enough so that it's not some rapid repricing, But Neil, I want to ask you about something when you were talking about the labor market, which is, a lot of people, I think, who are more gloomy about the economy, maybe you, they look at the unemployment rate forecast and they say, oh, these guys, what makes them think you're going to stabilize here? I found it notable that if you look in the tables in the SEP, the number of officials who see the unemployment rate this year ending at 4.6%. So there's 7 of them. That's up from 3 in the September SEP. But only one person has the unemployment rate at 4.6, and that's the high for 2026. So that actually suggests, you could argue that there's a lower bar to cut rates, once you get, to 4.6 or higher, because everybody who's writing down their forecast is saying we think the unemployment rate is going to be no higher than 4.5%, except for that one person next year. It reminds me a little bit, just to make a side point here, in 23, when we were all debating, are they done hiking? They would ratchet higher the inflation forecast in every SEP. We didn't get, now we think we're going to end the year at 3.9 instead of 3.5. And you'd actually lower the bar to end the hiking cycle because you'd make it easier to beat that now ratcheted higher inflation forecast.
Are they that sophisticated in doing that, or are they looking at it honestly? You know what I mean? If you're,
I don't think there's some sophisticated, we can deliver more cuts. I think it's telling you. Powell said, I think it was in response to my question, I asked him something about what gives you the confidence that you're going to stop here with unemployment rate that's been creeping up, as you said, I think 30 months. And he said, well, we think we've done enough to stabilize. He said something about tick 1 or 2 tenths higher. So I think that kind of tells you that they're okay with 4.5%, maybe 4.6%. Anything above that, take notice.
Yeah, so to me, what I found interesting within the SEP was the dispersion of views around rates for next year, but the sort of fairly narrow views around the unemployment rate forecast. A band of the band actually narrowed, I think. I think the high was 4.6, the low was 4.2. I think the low in September might have been 4, right? I found that interesting. Ultimately, like this business, your assumptions drive your conclusions, right? And if you're assuming unemployment to be flat and GDP to be strong, yeah, sure, then you shouldn't expect rate cuts next year. But
let's turn a little bit and look at the markets, because had all this Fed talk this week, and then by the end of the week, we're having indices making record highs, right, Jeff?
Yeah, the equal weight S&P made a new high. We had about 33% of S&P names make 20-day highs. That's not a momentum signal by any means, but certainly it's moving in the right direction. So really the broader market can confirm trend. And I think, importantly, it helped to really pour some cold water on the breadth bears that have been, in existence for, 2 or 3 years now, about how narrow the market is and how unhealthy the market is because it's only, the Mag 7 driving things. Well, you just got a lot of evidence, yesterday that that's not the case. The equal weight made a new high, and the cap weight is barely there. So I think there's a pretty healthy rotation that's taking place. I think interestingly, probably the dark horse here has been the metals, and I'm not just talking about gold and silver, but if you look at aluminum, you look at copper, and you look at steel, all those metals actually look really, really good. And the little bit of that is an offset to the weakness that we've seen in the dollar here after rallied right into kind of natural resistance zones and rolled over, and looks like it's resuming the downtrend. But I think the bigger question is what happens to crypto. And this is not a crypto shop by any means, but we certainly look at it as a
excuse me.
Measure. Oh boy, here we go. Zcash looks just as bad as the rest of them. So I'm just going to let you know that up front.
I read on a Reddit somewhere that Zcash is what you use to protect yourself against the debasement of Bitcoin. Bitcoin, of course, is what you use to protect yourself against the debasement of the dollar itself. So just so everyone knows.
That feels like that Princess Bride of "I know that you know that I know that you know." Is that, I think it's kind of the same thing.
Hey, Jeff, I wanted to ask you a question about rates.
Okay.
I'm looking at the 30-year. It's up 5 basis points.
Yep.
It looks like it's. I don't know if this is like sort of technical lingo. Like it wants to go higher. Like the 10-year looks like it wants to go higher. So I have 2 questions. Number one, is that a problem for equities? And number 2, do you think that's a function of stuff that's happening here? Is it a function of what's going on globally?
Look, I think the last question is the easy one, which is there's no way that you can look at the U.S. Longer end of the curve and say that that is a domestic issue, that's something that's specific to U.S. policy. It is global in nature. It's happening in Germany. It's happening in Japan. It's happening around the globe. The short answer to your question about whether it's a problem for equities, at some point it will be. I don't think we're there yet. But historically, if we look at this, the biggest driver of equities is the trajectory of the 2-year yield. So the short rates matter a lot more than the long rates. The second part of that equation is what happens to the curve. And so if you're looking for kind of the perfect scenario from a rate perspective that aligns itself well with forward returns to the S&P, it is contracting short rates in a steepening curve. So, in some ways, I don't mind seeing the 10-year stable while 2-year yields come in. What I'd prefer is obviously the 2-year yield comes in a lot more aggressively as the 10-year kind of drifts lower. But, officially from the setup, it's not bearish. I'd get concerned if we started getting the 10-year yield above that, call it 435 level. That'd start to be pretty uncomfortable for us. But at this point, I don't think it's a problem. And I think you're seeing that, and I know what you're saying about home builders with the data, but the charts of the home builders have actually stabilized and look okay. I wouldn't be pounding the table here on them, but they look okay at this point. I think the bigger issue from our standpoint is, why is crypto not acting like these metals or materials given the weaker dollar? They seem to have disconnected. And I think importantly for listeners is that you've actually got downtrends now. Bitcoin, which is kind of the gold standard, pardon the pun, of crypto, is in a very clear downtrend. Ethereum has been in a downtrend well before Bitcoin was. And then you've got the sketchy coins, which I won't put Zcash in there, but you've got some other sketchy coins that are out there that have been in downtrends for a long time. And they're acting like they're in downtrends. The oversold condition, which was almost perfectly timed with Williams' comments back on I think it was the 22nd of November. All those were oversold. They all rallied, but we had a lot of things that have rallied much more vigorously off of those lows than we've seen out of crypto. So that acts a lot more like a downtrend in my view, and certainly that's an area of concern, at least as we look at the landscape of the portfolio and allocations.
It's interesting what you mentioned about builders, right? Because do you think that's this is for maybe a question for Pavlick, but do you think that's like a function of like 10-year yields are going up, builders are hanging in there, mortgage spreads have been coming in all year? And is the administration taking steps to juice the financial deregulation story?
Look, there's always a lot of things that are going into it. I think one of it was there was so much negative sentiment for home builders that just kind of a relief from that is helpful. And, you're catching a little bit of that bid. So we'll see how that plays out, because we don't see it in building products. We don't see it in construction materials. There's a lot of downstream or upstream, however that works, that is not confirming what we're seeing out of the home builders. So we'll have to wait and see on that.
Nick, do you get a lot of, is there a lot of talk about, crypto and stablecoin within the halls of the Fed? Do you hear a lot of that?
Maybe I would if I was asking more about it. It's just not something that really is relevant to what I'm writing about on monetary policy. So, Myron had an interesting speech a couple weeks ago, stablecoin implications for treasuries, but the answer is no, and it's mostly because you only learn about the things you're asking folks about, and it's not something that I've really been writing about.
Right.
Nick likes to keep his credibility within the walls of the Fed. He doesn't really.
No.
Next, it'll be UFOs. What about these UAPs? How's the Fed?
There's plenty to write about apart from that right now. We have other people who do a good job on that.
If we hear him talking about Zcash, we'll know where we got it from. Speaking of asking questions, let's move to the mailbag for a second. As a reminder, put a question into our LinkedIn or X account, and you'll get. We use it on air. We'll get you'll send you a nice hat. We got a request from a good friend in Cape Town this morning for one of these RenMac trucker hats.
So one of the hats. These are the new ones. I've got this on right now. The RenMac. This is the Carhartt RenMac hat. This is more your, horseback riding rancher style hat, but it's got a nice warm kind of patina to it. Yeah, I'm a big fan of it. So you can get it at the RenMac merch store. Don't forget that. We're getting stuff out there. The big one though, the best seller so far has been the sesquicentennial. Is that how we say it? Sesquicentennial hat. The RenMac, which I actually don't have one. So
that's for the 250.
I think it's semi-quincentennial.
What is it?
Semi-quincentennial.
It had to be a lot more. Yeah, right. It had to be much more difficult to pronounce than anything I could come up with. So, yeah.
Pat, it's nice to hear your voice. We'll get to you in a second.
Just here to help. Just
cleaning up the mess when it comes up. So.
Harry, are you there? How about the mailbag today?
Today we have the question come from Frank Pfeiffer. His question is, do you prefer ETC over BTC? That's it. Thank you.
We prefer ZEC over both of them.
We're back to the cryptos. So the question is, do you prefer Ethereum to Bitcoin? Look, if you're looking at the charts, neither one of those are good charts, but I would say Ethereum is the weakest of the two, and it really kind of cascades from there. So Bitcoin, as I mentioned before, is a bit of the gold standard of crypto, and then you drop it down to Ethereum. We tend to watch Bitcoin as the tell for crypto, just because it's been the most established. It was the OG, if you will. And so that is the more important one for us. Again, we're not a crypto shop by any means, but in terms of animal spirits and how we think about the world and what's happening, that's certainly the one that we pay attention to. They also trade futures, which we will look at with the positioning within the futures market of who is the more urgent longs versus shorts, and just get a better understanding as to what's happening there. But as I mentioned before, all are in downtrends. Bitcoin is in a downtrend with important resistance right at a cool 100,000. So it's a nice, easy number to remember. But that was a pretty big top. 50 days crossed through the 200-day. There are a lot of indications of a trend change or break from up to down there. So just be careful with that.
Frank, thank you for that question. We'll get you a RenMac trucker hat. Patrick Torrey from Schwab, thank you for that question around home builders and the housing market. And of course, Tom Robbins, our friend in Cape Town, South Africa. We'll get you one because it's summer down there. Pavlick, what's going on in DC? Anything?
Well,
oil tankers, AI. What are we doing?
Well, oil tankers aren't really an issue in DC. That's more a Venezuela thing. We'll talk about that in a second. But first, I just want to acknowledge it's nice to have a fellow Hoya on the podcast. Nick, welcome. I want you to preserve your credibility, so I won't ask you to comment on this. But as a Washington watcher, I am obviously attracted to conspiracies, so I can't help but wonder if we saw this regional Fed bank president announcement as maybe a handshake deal with Powell, who's focused on preserving independence. Is that sort of, if you guys agree to do this, I'll agree to step down when my term as chair ends in May and not stay on until my term as governor expires until January 2028. Again, Nick, I'm not going to ask you to comment on that, but I can't help but wonder from where I'm sitting. But to Steve's question about Venezuela, look, I think, people ask about Trump's interest in Venezuela. They'll point to oil and beautiful women, both of which are in abundance down there. Perhaps that's it. I think it more has to go with Secretary Rubio. He's really had a strong focus on Venezuela in the leadership there with Maduro for a long time. And I think you've seen his influence reflected in this national security strategy. And really, I think it's about asserting some regional bloc dominance there. And I think, this effort now focused on the oil. We've seen the emphasis on the drugs. I mean, what you're doing is trying to hit the money and really, raise some concerns that are now amongst the oligarchs, the viability of the Maduro regime. Again, raise that concern there. And then I think with respect to the military operations, again, it's under maybe the guise of addressing some of the drug concerns, but again, raise that concern amongst these military officials. Is this the guy you really want to prop up? I think Maduro is still betting on Trump not to want to intervene militarily with troops on the ground, and that may be a good bet, and that may be part of the negotiating situation that we have going on. So that may continue to play out for some time. Ultimately, though, I think we're going to see some regime change there. As to when, I'm not sure, but I suspect that's what's really driving this. Outside of that, I think the big thing this week, a lot of attention on the failed healthcare votes in the Senate. I think the optimistic case is that you sort of had to get the partisan show votes out of the way. Maybe some bipartisan support for some sort of extension will rise from the ashes. I don't know that I would necessarily bet on that, but I think that's the hope. So that's really going to be linked to January 30th. That's when the government funding deadline's coming up. My guess is you're going to continue to see conversations that would include some sort of extension of the ACA subsidies beyond that. I think you probably have to look at a 2-year period because Republicans don't want this to align again with another election, whether it's 1 year or 3 years, that's a risk. And then they're going to want some sort of income cap and some fraud prevention measures there as well. Whether or not that materializes before the end of next month, we will see. But I think that's sort of one of the big news stories here. The other thing I would keep an eye on, the House passed its version of the annual defense policy bill. The Senate will take it up next week. That will pass. It's not a question of whether or not that will move. The thing that jumps out, I think for this version of the Senate NDAA is the fact that we have an outbound investment screen. This was something that had been tried to be inserted going back to when I was at Treasury during the first Trump administration. It never was. And so the fact that it's there now, I know Jeff talked a lot about investments in China, particularly Chinese technology companies. And this is really meant to discourage that. Again, the goal of the policy is, we don't want U.S. investment dollars funding areas of these critical technologies which we're competing with China. So, I think people looking to invest in that space may have to consider that moving forward.
So,
Yeah,
Steve,
let me ask you a question real quick for either one of you, Steves. Who's going to have a worse 2025, Maduro or Sharon Moore?
2025 or 2026?
Well, 2025. I mean, I don't think it can get any worse for Moore in 2026. Sorry, that was just a little dig there, Steve.
I think Maduro.
Oh, really? Wow.
Yeah.
Okay.
Yeah.
That's saying something.
I think the other side of that, Steve, I think Maduro's going to end up on some like Caribbean island somewhere on the beach with billions of dollars, maybe in Zcash, to Neil's point that he can sort of move around and not have to worry about anything. So I'll take the other side of that.
Can we get him on the pod? Does that work for Maduro on the pod for Zcash endorsement?
He may have some free time coming up soon, so we'll see.
Yeah.
Since you're on things to watch this week, Steve, one thing that happened yesterday was this executive order around this AI legislation, right? Want to talk a little bit about that?
Sure. And again, I think it's been sort of telegraphed for a while. We talked about the defense bill. One of the things that fell out of the negotiations was legislation that would have codified this. This was something that NVIDIA CEO Jensen Huang had been pushing. And I think from an AI maker perspective, they don't want to have to deal with 50 different operating environments. If each state is sort of governing AI by various rules and restrictions, so they prefer one standard. I think with respect to states, this is a new technology, and there's obviously some concerns as to how it'll be used, developed, and so I don't know that states are necessarily interested in giving up their authority there. And I think this vehicle of the defense policy bill, I think for federal representatives here, hearing a lot from their state governments, sort of hey, maybe this wasn't the best venue for it. I think the fear, though, is now that we have an executive order, they're not as legally durable as laws. And so the question will be, if we see a change in administration in 28, at least in terms of Democrats taking over, are they going to have the same EO? Are they going to look to modify it? That doesn't provide that certainty when you're talking about these long-term investments. So that's something to watch. And then two, you're going to have inevitable legal challenges to this. Maybe some will be brought by the state, infringing on their rights. So I don't think this is the end of it. And that's something to watch moving forward. With respect to next week, the Senate will take up the defense bill. I suspect that will be it for Congress this year. We're really going to have a jam-packed January because when lawmakers return, they're going to probably try to address some sort of deal here on the expiring Affordable Care Act provisions, which will have expired by December 31st. But they hope that they can sort of reach some solutions starting in January. You also have to address the government funding deadline on the end of January 30th. The question there is, do Democrats really want to repeat the exercise? Some I think are going to argue, hey, this issue has elevated healthcare, which is more favorable terrain for Democrats with talking about affordability. And there's also a risk, I think, that some are considering, look, are we going to overplay our hand? We shut down the government again after we've already had this healthcare discussion. Do voters start to turn on us? They've had a lot of momentum, they being Democrats recently with some of these election results. So I think that debate's going to continue probably into the beginning of next month.
Neil, what are you watching this week?
Well, we do have some data finally. The BLS is going to release November non-farm payroll data. We get partial data for October. What I would just say is, right now, considering, the sort of uncertainty around like immigration enforcement, I just think it's best to just focus on the ratios in the household survey to get a sense for what's really going on with the labor market. Frankly, to the extent that you want to pay attention to something in the establishment survey, I'd probably focus on hourly wage growth, the average hourly earnings. But I do think that the unemployment rate has the most importance, not necessarily the jobs numbers, because as Powell kind of suggested, like whatever that number is, it's probably being overstated by some amount, which is an argument, again, that Waller was making earlier in the year. We also get retail sales. Remember that retail sales in September was not good. The core sales was actually down 0.1%, and we should see some rebound, but it just means that the handoff into Q4 wasn't that strong. I do think it's interesting because before the government shutdown, the sort of main macro question that everyone was kind of wrestling with was just trying to reconcile the GDP, like sort of expenditure side add up of growth versus labor market data, right? And historically, And the labor market data is the one you want to go with, right? Like, so in other words, if total hours worked aren't growing, it's likely that the economy is not growing 3.5%-4%, which is kind of what the tracking numbers were showing. So now that we're finally getting some of this, the retail sales data and durable goods and things like that, we'll probably get a better sense for how those two data lines are going to converge. The one thing we're missing, frankly, is housing. I mean, we haven't gotten like a housing starts or new home sales number in months. I mean, that's kind of annoying. We'll also be getting the inflation data for November. Labor Department's not publishing the October number because there was nobody out there canvassing those data points, I guess. But that'll be the other indicator to watch.
Nick, what's going on at the Fed this week? Anything?
Well, for me, I'm focused on the Apprentice Fed edition. I think we're getting closer. Bessent has said before Christmas, and then it looks like they got Trump to say early next year. And my take of what's happening here is, Trump seems to have concluded he wants someone he knows quite well. Scott Bessent won't do it, so Kevin Hassett. But, there was the reintroduction this week of the capital P process, right? Bessent has tried to impose a process, and he wants to bring these candidates in for interviews. Kevin Walsh had his interview this week. So what I'm watching is, does anything from the capital P process that Bessent has been kind of curating since August, it's already accomplished a couple of objectives. It slowed down the announcement. We didn't get a September or October announcement, which they had been talking about. It got people to create an argument for cutting, it brought out people, Mark Summerlin, Jim Bullard. You socialized kind of talking head commentators to say, actually, there are good reasons to cut. So the process succeeded on that. But, you hear these whispers around, well, they're running the process because they want to get Trump to pick someone else. And so now we're going to find out if that in fact happens. The fundamental question I have is, would Donald Trump pick anybody for this job who he does not know very well, including really people who have been working for him for at least this year? And we'll find out.
Any chance we get whoever it is, we're going to get those cool little pictures in the Wall Street Journal back, the little pixelated pictures?
The little stipple drawings?
Yeah, we're going to get those back?
They don't run those much anymore. Alan Greenspan actually didn't like his. And so whenever people would complain to me, when I started here and we still ran those, they'd say, I don't like my stipple drawing. Can you redo it? And I'd say, if Alan Greenspan, who, before the GFC was the GOAT, if he couldn't get one changed, what chances do you think you are? But now we don't run them as much, so I guess we don't have that problem.
There you go. We'll bring them back. The old school, right?
I had one, and I didn't like mine either. But I don't think there's much you can do with this mug. So I'm just resigned to the fact that black or white, whatever it is, it doesn't matter.
Nick was saying the other day they used to have a program right on the site. If you were a subscriber, you could get your own picture.
They had a tool. A few years ago, they had a tool where you could upload a photo and get one. I've had a couple of different ones because I didn't like mine once, and they said,
See, there you
such a diva. We'll go.
No, I think it's just called Nano Banana, right? Yeah.
Like you said, the hair. You got to get the hair in there. So.
You got to get. That's the main thing.
No doubt.
Jeff, what are you watching this week?
Look, you had a good week for banks. I don't think that's a huge surprise given what happened, at the Fed. But the banks, even though financials have actually been under pressure, most of that pressure has been focused in the payments and in some of the insurers and some the private equity names, not really the kind of stalwarts of finance, which would be consumer finance names and banks and brokers and the like. So I was relieved and encouraged by the breakout that we saw in banks. Those are good charts. They've been really just consolidating. So we'll see about the follow through from there. But it's really watching this rotation, and that's what that that new high in the equal weight index suggests, is that there is this rotation that's taking place and this broadening of the market. So where's the leadership going to end up being? We've talked about healthcare and some of the breakouts that we're seeing there and the relative performance and just the god awful performance that we've had over the last 3 to 5 years. So there's a long runway for those names, but we've also seen some improvement in some of the energy names, particularly the equipment and service names. So there's really a little something for everybody. Even in discretionary, the broadline retail looks okay. So this is a really interesting market. Whereas on CBC maybe a week ago, and we talked about a lot of opportunities on both sides of the ball, and that's totally true. I mean, I think think you can find as many shorts in a sector as you can longs, basically. And I think there's a lot of opportunities just as we kind of wade our way through this whole mess. I wanted to just ask Nick something real quick, because I know people have asked a question on this, and maybe if you can just give us your insight on this, Nick, on the $40 billion that the Fed stepped up in terms of the purchases. Some people calling that QE, et cetera. Walk us through just real quickly your interpretation of that and how you see that.
Right. So the Fed announced these reserve management purchases. They're starting today. This is really it's not QE. Does it have no effect on money markets? No, of course it has some effect. That's why they're doing it. They want to maintain better control of the Fed funds rate. And so what happens here is if they don't do this, and reserves will continue to decline as other Fed liabilities like cash in circulation grow, and demand for reserves grows over time if you have if nominal GDP is positive. So what the Fed's doing here is really just saying we don't want to continue to kind of passively shrink reserves, which is what would happen. I mean, when the Fed grew the balance sheet between 2000 and 2007, nobody called that QE. They didn't, that wasn't a thing. Now, obviously, these are larger purchases. I was a little bit surprised in October that they ended QT on December 1st instead of November 1st. But now they're coming in and they're saying, well, we don't want to get too low, so we'll buy more through tax season in April. But that's all that's happening here. It's really about making sure that the policy decisions you make can get implemented effectively into markets.
We're in an ample reserve regime, and we're at the lower end of that boundary, and now they're helping to manage that. It's a brand new world.
They should just put a footnote instead of giving these details in the statement. They should just put a footnote, like an asterisk, like, yeah, this is our policy, and we're letting the markets desk at the New York Fed figure it out.
Well, I wouldn't at all. I would be surprised, frankly, if in the next FOMC statement you see that they had that sentence in there this week saying they're doing it. But I think, Neil, that's what you'll see going forward. It won't be. I would be surprised if it's in the FOMC statement. It'll just be look in the implementation note and look at the New York Fed directive, and you'll find out, whether it's 20 billion or 40 or whatever. But they don't want it to get any attention. And frankly, it shouldn't. If you don't like it and you want to change the operating regime, you can have that fight. But this is the regime that they're going with.
I mean, when I got in the business, it was a cottage industry on whether the Fed had cut rates or not, right? I mean, people would go through the balance sheet and figure out it's a completely different.
Didn't you get into the business before the Fed even came into an existence? I mean,
yeah. So who had a birthday?
I mean, you were like reading like JP Morgan's like briefcase size to like figure out whether they were going to like bail out the financial system or not.
It was how fast his carriage was going. That's how I figured it out. That's how fast his carriage was getting downtown. That's what the whole inside track was. But our moderator had a birthday this week.
I did.
Happy birthday, Steve.
Thank you very much, Jeff. Double nickels. How about
what's
that?
your? Is that right? Okay,
Yeah.
I wasn't going to give it away. So is that like, what's your favorite multivitamin? What do we do at 55?
I got to tell you, it's amazing. You get older, everything starts to creak a little bit, right? Arms, everything starts to hurt. Yeah, a lot of multivitamins, a lot of juices, a lot of. Well, since it's my birthday, I'll call it a day here. That's a wrap. We'll be back obviously next week. Nick, you won't be back with us next week, but you're always welcome to come back. I really appreciate you joining us today. So thank you.
Thanks for having me.
You bet,
Nick,
for your insight.
Thanks for making it.
As everybody knows, you can go to renmac.com to find out what more we do here. You can follow us on X. You can follow us on LinkedIn. Follow us on YouTube. Lots of ways to get the RenMac stuff. Obviously, we'd love you to be a client, so get to renmac.com and either get on our newsletter or subscribe to the institutional side, or however you want to get to us. We'd like to have you on as a client. Also, go to renmacmerch.com because you can get the sweet merch. All proceeds on that site, like Jeff's Carhartt hat, go to the Make-A-Wish Foundation. So this time of year, always good to do something a little outside the norm. Until next week, I am Steve Duttenhofer.
I'm Jeff deGraaf.
I'm Neil Dutta.
I'm Steve Pavlick.
That's Nick Timiraos. Thank you, Nick. Appreciate you being on.
Thanks so much.
Thanks,
See you guys.
everybody.
Thanks, Nick.